How does money supply growth create asset bubbles? Imagine a river suddenly swelling with extra water. That's what happens in the economy when the money supply grows rapidly. It floods the financial system with more cash than usual. When central banks or governments increase the amount of money in circulation, it makes borrowing cheaper and easier. Interest rates fall, so people and businesses can take out loans at lower costs. This extra money fuels demand for assets like real estate, stocks, and bonds. As more money chases the same assets, prices start to rise beyond what the actual value or earnings support. This surge in demand pushes prices higher, even if the underlying fundamentals haven't changed. Investors see rising prices and expect them to continue, so they buy more assets hoping to sell later at a profit. This creates a feedback loop where rising prices attract even more buyers. The more money available, the more investors feel confident to buy assets, pushing prices further up. Sometimes, this leads to a situation where asset prices are disconnected from their real worth, forming a bubble. Inflation expectations also play a role. When people see prices rising, they might prefer to buy assets like real estate or stocks as a way to protect their wealth. This increased demand pushes prices higher still. Rising asset prices make owners feel wealthier, encouraging them to spend and invest more. This wealth effect can keep the bubble growing. Speculative behavior is another factor. Investors might buy assets not because they believe in their long-term value but because they think they can sell at a higher price soon. This behavior inflates the bubble even more. Limited supply in certain markets like housing can make prices spike faster when demand increases. When money supply growth causes asset prices to rise sharply, it can lead to inflation in those markets. Prices go up quickly, not because of better earnings or productivity, but because of excess money chasing limited assets. This creates asset bubbles, which are a sign of inflationary pressure in specific sectors. If these bubbles burst, it can cause sudden drops in prices and economic instability. That's why understanding how money supply growth influences asset prices is key for keeping the economy stable. In short, when the money supply grows rapidly, it floods the economy with liquidity, lowers borrowing costs, and encourages investors to buy assets. This increased demand pushes prices beyond their true value, forming bubbles that reflected inflation in specific markets.